3 days after the bank approved his loan, Michael O'Hara stood on the sidewalk staring at the keys to his first truck. Not a new truck 1978 Ford, paint peeling, 300,000 miles, but the $20,000 in his account meant he could bid on the courier contract that 8 other drivers wanted. That night, his daughter asked if they could finally fix the heater. He said yes. By morning, his competitors were still sleeping. Michael was already delivering. This is the moment everything changes. Not gradually, not eventually. At exactly $20,000. In 1947, the average American household earned $3,100. $20,000 wasn't a milestone, it was a fantasy, the property of industrialists and landowners. Yet census data reveals something profound. Families who accumulated this amount by 1950 showed a 340% higher rate of small business formation within 5 years. They weren't wealthier, they were structurally different. The Federal Reserve's Survey of Consumer Finances, tracking behavior since 1962, confirms the pattern persists across every economic cycle. Above $20,000 in liquid assets, families default on catastrophic debt at 72% lower rates. Their planning horizons stretch from months to years. Their children complete college at double the national average. The mechanism isn't mysterious. Princeton research from 2013 demonstrated that financial scarcity consumes mental resources equivalent to a 13-point IQ reduction. Below the threshold, the brain remains in survival mode, optimizing for the next payment, the next crisis, the next shortfall. Above it, executive function returns. Long-term decision-making becomes possible. The University of Cambridge tracked cortisol levels in households crossing this boundary and measured an 80-month decline in stress hormones that directly correlated with improved health outcomes and increased earning capacity. Security doesn't just feel different, it operates differently. In 1944, James Thompson received a letter from the War Department. Inside was a voucher for educational benefits worth, in today's dollars, exactly $20,000. His father, a coal miner in Pennsylvania, had never saved more than $600 in his life. James enrolled in engineering school. His younger brother, who missed the draft by 6 months, did not. By 1965, James owned a home, 2 cars, and his children attended private school. His brother worked the same mines their father had. The difference wasn't ambition, it was threshold. Behavioral economists call this security liquidity, the precise point where available capital exceeds the maximum cost of likely emergencies. Daniel Kahneman and Angus Deaton's 2010 research on emotional well-being identified $75,000 as the modern plateau, point where money ceases increasing daily happiness. But the foundational principle occurs much earlier. At $20,000, the mathematics of life change. Compound interest gains critical mass. Investment participation jumps from 12% to 61%, according to Vanguard's retail investor analysis. The same amount invested in 1980 generated $1.2 million by 2020. Invested in 2000, with less time to compound, it yielded 76,000. Time and threshold intersect to create wealth or deny it. The shift reveals itself in mundane decisions. Households above this level maintain insurance deductibles 3 times higher, choosing lower premiums because they can absorb shocks. They refinance debt at rates 2 percentage points better, saving tens of thousands over loan lifespans. They negotiate medical bills instead of avoiding them. Each decision reinforces the threshold, creating upward momentum that appears as individual virtue but is actually structural advantage. The Wisconsin longitudinal study, tracking thousands of families from 1957 through 2004, found that GI Bill recipients who received precisely this threshold amount in educational benefits surpassed non-recipients in median net worth by $183,000 within 2 generations. The money didn't make them smarter. It made strategic thinking possible. December 1971. Richard Nixon announces the dollar will no longer convert to gold. Inflation begins its silent assault. A family with $20,000 in savings watches their purchasing power erode at 7% annually. But the family who used that same $20,000 as a down payment on a duplex watches their tenants' rent checks rise with inflation while their mortgage payment stays fixed. Within 7 years, one family has $12,000 in real value. The other has $104,000 in equity. Same starting line. Different universe. The historical record proves the threshold moves but never disappears. In 1938, when the Fair Labor Standards Act established America's first federal minimum wage at 25 cents per hour, $20,000 represented 80 years of labor, unattainable. By 1971, when Bretton Woods collapsed, it marked the entry point to financial markets for average citizens, the minimum needed for diversified mutual funds to make sense. Today, it remains the point where robo-advisors, index fund strategies, and compound growth become accessible and meaningful. The number changes. The gateway remains. The mathematics are unforgiving. A household earning median income and saving 5% annually requires 8 years to reach $20,000. During those 8 years, any single emergency, medical, automotive, familial resets the clock. After crossing, the same 5% savings rate generates $40,000 in 6 years, $80,000 in 5 more. The difference isn't the savings rate, it's the immunity to reversal. The Federal Reserve's 2022 analysis confirms that families above this threshold recover from income shocks in an average of 11 months. Those below require 3 years, and many never recover at all. In 2019, researchers at Johns Hopkins placed heart monitors on 2 groups of warehouse workers. Those with less than $20,000 in savings showed elevated heart rates throughout their shifts, spiking before every shift began. Those above the threshold showed normal cardiac patterns. The work was identical. The pay was identical. The difference was the account balance, and it showed up in their arteries. Financial stress doesn't just influence decisions. It rewires biology. Context determines the threshold's power. In 1954, when Brown versus Board of Education desegregated American schools, $20,000 in a black family's savings meant something different than in a white family's. It meant private school tuition when public schools remained hostile. It meant moving to a neighborhood with better opportunities despite redlining. It meant paying cash to avoid discriminatory mortgage rates. The amount was identical. The strategic value was magnified. The historical analysis of the black bourgeoisie from 1940 through 1980 shows that families crossing this threshold achieved intergenerational mobility at rates approaching white families, while those below remained trapped regardless of income. The number itself is neutral. Its impact is not. Modern data reveals the threshold's evolution in 2023. $20,000 covers 4 months of median household expenses. Yet behavioral patterns persist unchanged from 1950. Households with this amount in checking and savings accounts demonstrate the same 340% increase in entrepreneurial activity, the same shift from reactive to strategic thinking, the same measurable decline in catastrophic decisions. The mechanism is timeless. Security enables risk-taking, liquidity enables patience, capital enables strategy. The year is 2025. 2 rideshare drivers complete their 3,000th trip on the same day. One has $18,000 saved and continues driving because stopping means falling behind. The other crossed $22,000 last month. Tomorrow, she reduces her hours to enroll in a coding boot camp in 6 months. One will still be driving. The other will be building software. Today, they were equals. The threshold has already decided their futures. This is why everything changes at $20,000. Not because of greed or ambition, but because human cognition functions differently above security's waterline. The compound interest, the investment access, the stress reduction, the strategic horizon all combine into a self-reinforcing system that appears as individual virtue but operates as structural physics. Historical analysis across 70 years of data proves the threshold is not a cultural construct or a motivational slogan. It is a measurable inflection point where probability shifts. The number will continue evolving. In 2040, it may be $50,000. In 2060, $100,000. But the principle remains. Certain capital thresholds rewire human potential. $20,000 is not wealth. It is not success. It is simply the point where survival ends and strategy begins. Where reaction gives way to planning. Where the mathematics of life fundamentally reorder themselves. Everything changes here because here, for the first time, everything becomes possible.